Back in the day, Wall Street was run by people. You know the type: tailored suits, expensive watches, and egos the size of small countries. Think classic, larger-than-life finance personalities. Because for most of modern financial history, investing was simple. You hired a person. That person would read filings, listen to earnings calls, analyze valuation multiples, and then ignore all of it because they had a feeling about some biotech startup. And honestly, it was kind of beautiful. Sometimes they were right. More often they were wrong. But at least it felt human. There was always a story. The management team looks strong. The balance sheet is solid. This stock just feels cheap. Which, if we're being honest, is basically astrology for men in cufflinks. And for decades, this worked. Markets were inefficient. Data moved slowly. Information had value. This was the golden era of narrative-driven investing. But then, something changed. The math nerds showed up. People with PhDs, math competition medals, and dreams filled with probability distributions. And in the late 1980s, they realized something important. Markets aren't completely random. They're statistical. Patterns exist. Human behavior repeats, and inefficiencies create opportunities. And that's where quantitative investing was born. Because instead of asking, "Is this a good company?" they asked, "Given these variables, what's the expected outcome?" It was rules over stories, probabilities over opinions, math over gut feelings. And it worked. Quant hedge funds started popping up everywhere, but one stood above all the rest: the Medallion Fund. It was run by Renaissance Technologies and founded by mathematician Jim Simons, and it completely changed the game. No stock picking, no TV interviews, no intuition, just math, algorithms, data. And the results were insane. For over 2 decades, Medallion generated more than 60% annual returns before fees and around 39% after fees. To put that into perspective, if you invested $10,000 and earned around 19% annually, the kind of return legendary investors achieved, you'd end up with roughly $324,000 after 20 years. But at Medallion's returns, that same $10,000 would grow to over $7 million. Yeah, it was that dominant. And it changed everything. Because now, instead of humans making decisions, machines were reacting instantly to price movements, order flow, volatility, thousands of signals at once, faster than any human ever could. While quant funds quietly took over institutional investing, something else was happening at the retail level. People started realizing something uncomfortable. Most active fund managers aren't very good. Study after study showed that roughly 90% of them underperformed their benchmark over the long run. And once you factor in fees, it gets even worse. So investors started asking a simple question: why am I paying more to get less? And that's where index investing comes in. Low cost, passive, no guessing. Instead of trying to find the needle in the haystack, investors just started buying the whole haystack. At the same time, institutions were shifting capital too, away from traditional stock pickers and towards quant firms, private markets, and internal strategies. The traditional money manager slowly becoming irrelevant. But even as that role faded, the need for portfolio management didn't go away. Things like asset allocation, rebalancing, and tax optimization still mattered. The boring stuff. And that's where robo-advisors enter the picture. Now, let's clear something up. Yes, robo-advisors use algorithms, but not like quant hedge funds. Quant firms use algorithms to exploit tiny market inefficiencies and generate alpha. Robo-advisors, they're just automating the basics. Think of it like this. Comparing a quant fund to a robo-advisor is like comparing a Michelin star chef to instant noodles. Robo-advisors aren't trying to beat the market. They're trying to match it, cheaply and efficiently. They handle asset allocation, rebalancing, tax optimization. All the things a human advisor would charge you 1% a year to do, usually in a spreadsheet. And people love that. Platforms like Wealthfront and Betterment have exploded in popularity. Over the past decade, assets managed by robo-advisors have grown from billions to trillions globally. This isn't a trend, it's a structural shift. But it's not perfect. Because while robo-advisors market themselves as personalized, the reality is very different. You answer a questionnaire. Your age, income, goals, risk tolerance. Feels customized, right? Not really. Because behind the scenes, you're just being placed into a category. and assigned a model portfolio shared by thousands of other people. It's not tailored, it's standardized. And that's the big misunderstanding. Robo-advisors aren't replacing human judgment. They're replacing human operations. Because historically, financial advisors weren't really paid for beating the market. They were paid for access. Access to information, access to markets, access to products. And for a long time, that made sense. But then the internet happened. Information became free. Data became accessible. Tools became mainstream. And suddenly, paying 1% a year for access started to feel outdated. This has happened before. Travel agents didn't disappear because people stopped traveling. They disappeared because booking a flight stopped requiring a phone call. Stockbrokers didn't disappear because people stopped trading. They disappeared because clicking buy became easier than calling someone on a trading floor. Whenever access becomes free, the middleman gets replaced. And that's exactly what's happening here. Robo-advisors aren't revolutionizing investing. They're automating the middle layer. So this isn't really a story about whether robo-advisors are good or bad. It's a story about what happens when technology finally hits a stagnant industry. Because when it does, it doesn't tweak things. It rewrites them completely. So now I'm curious. Would you trust a robo-advisor with your money? Or do you still prefer the human touch? Let me know.